Welcome to Morningstar. I'm Holly Black. With me is Louise Babin. She's a fund analyst at Morningstar. Hello.
Hello, Holly.
So we're here today to talk about the fact that gilt yields in the UK have gone negative for the first time ever. What does this mean?
Well, actually, it's the second time. So there was a very short period in 2016 when 1 month paper went negative. But it's the first time really with a more conventional bond. So it was a 3-year maturity gilt yesterday, which feels like ages ago now. It was 3.8 billion. The auction was 2 times oversubscribed. And technically, what it means is that the people that won the bid, who bid the highest prices, were willing to pay more the gilt and the sum of the coupons and the principal repayment.
Okay, so a gilt is a debt that's issued by the UK government. So if that's being issued at a negative rate, what does that tell us about the outlook for the UK at the moment?
Mainly 3 things. I think firstly, obviously investors are expecting a recession around the corner, and also possibly that Bank of England base rates are going to go negative. They're currently 0.1%, so almost there. But to turn negative, obviously, is quite a big thing. Secondly, and possibly, I think the most important driver of this week is inflation expectations. So we had an inflation print this week coming at 0.8%. It was half the previous inflation figure. Likely mostly down to a drop in the oil price, but also, this change in consumer demand, the shocked demand from the economic lockdown. Real yields on gilt, so that's yields after you account for inflation, were already negative. So this is not a big change. And I suppose what we're talking about now is what's the expectation, what's the outlook for inflation. And it seems from the figures we're looking at, we're expecting that inflation to drop even lower, possibly become disinflation, which is negative, and then we could look at a wider deflationary trend. And then also, if you look at where the negative yields are concentrated on the yield curve, so we look at entire universe of government bonds, but they mature in 6 months all the way out to 30, 40, 50 years. And the negative yields are only isolated in kind of around 3-year, 1 to 5 year part. So that implies that investors are expecting this to be a short-term thing in terms of the demand shock, disinflation, and lower bank rates. So at the moment, 3 things kind of in play there, but we will see obviously as things unfold later on this year.
Okay, so I suppose the big question is, what does that mean for me as an investor? Do I have to do anything to my portfolio? Is it going to affect me?
It's not necessarily bad news, actually. So we've luckily seen this play out over the last, must be 8 years now, in Europe, and particularly with German bonds, the most expensive European bonds. They've languished in negative territory in terms of government bond yields for years now. But if you look at returns in the last 12 months, investment in the German bond ETF has actually delivered a Euro investor about 3%. It doesn't make much sense, but when we look at actually how that works, there's a couple of things. So we have to see, is the whole investable universe in negative yields, or can you just pick parts of the curve, so different maturity bonds that actually have positive yields? So at the moment, as I said, you could pick a 10-year yield and you'd still get a positive yield on that. We also look at whether the curve is upward sloping. So if the yields on longer dated bonds are higher than on shorter dated bonds, you can actually get this roll down effect, we call it. So as the time passes and the bond becomes a 9-year bond, an 8-year bond, a 7-year bond, a 6-year bond, and so on, as the yield falls down, you get a capital boost, which we call roll down, and it can provide a very strong source of returns for managers. And then lastly, it's whether or not a manager can invest off or outside of their benchmark. So there are bonds that we call quasi-sovereigns or supranationals, and they basically are bonds with implicit or explicit backing from the government. And they tend to provide a small yield premium. It's not huge, but at times it can be enough to really make that difference between a negative and a positive yielding investment. So I'm not actually overly concerned for investors as the situation is. I think there's plenty our managers can be doing. And definitely it has helped that we've seen Europe go through this already and how they coped, because at the time it was a bit of an unknown, but we've seen how the mechanics are working out.
Louise, thank you so much for your time. For Morningstar, I'm Holly Black.